Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend show. This weekend show we are going to be focusing bit more on the commodities sector. I think you all know how much we like to focus on commodities, but quite frankly, there are a number of commodities that are doing quite well right now. There's also markets that are doing quite well right now, as the S&P, as we're recording this, closing in on all-time highs. But look, quite frankly, commodities are also showing some signs of life and some breakouts. So a lot of opportunities for investors out there, and we're hoping to really give some of you short-term traders and midterm traders an outlook here of where some of the best upside could be and if there are any warning signs out there. Just as a note, please go back through our website, podcast, and YouTube channel. You can even find us on Substack. Just search the KE Report, and that's where you can get all our market daily editorials that we release every day and company updates also released every day to stay up to date on what's happening in the markets and with some of your favorite companies. Thank you, everyone, for continuing to send us emails outlining companies you want to see on the show and your thoughts on those companies. Let's get into this weekend show, kicking off the show with Dana Lyons. Dana is a fund manager and editor of the Lyons Share Pro website. I really enjoy chatting with Dana almost every 2 weeks just to get insights on what his internal models are telling him about opportunities in markets and some of the commodities. Dana, I'm going to force you to focus a bit more on commodities in this segment, starting off with oil. What a wild ride last week was for the oil price. Yes, geopolitics, war escalation, and then de-escalation in the Middle East spiked the oil price and then brought it right back down. Right now, right around that $65 a barrel level, which seems to be pretty important considering that was the lower part of a range that oil was in for a number of years. So Dana, what are your models telling you? More or less probably taking that noise from last week out of the picture. Where's oil going from here?
Yeah, thanks, Corey. Specifically in commodities, we don't apply as many models, quantitative models to it, more or less just charting analysis and then run it through our relative strength fund selection models. So if there are commodities that should be invested in, we'll pick up on that. It's not that we have specific modeling on the various commodities, though, but looking specifically at crude oil, you had a very clear trading range really for the last 3+ years. You had a very clear floor that had been held for over that time. In early April, broke down from that support. We were short at the time because we anticipated that breakdown. Thought it had more to go, and then the Middle East tension arose. And you know us, we don't like to ascribe exogenous events on price movement or look outside of the market data for excuses on why markets move. However, I think it's pretty clear in this case that, like you said, the escalation in the Middle East caused oil to spike back up above and reclaim that former support area and open up further upside. And just as soon as that started, the de-escalation caused that drop. Kind of just the air came out of crude oil again and back below that key level that we were looking at. So right now, I would say benefit of the doubt is back to the downside in crude oil as long as it remains below those former lows, those multi-year lows. So we've got no position on now, but at the moment, I would say benefit of doubt would be to the downside again there.
Dana, what about if you look at the equities, and I'm thinking of the ETFs, XLE or XOP? Any thoughts there? Because sometimes the equities will travel a little differently than the commodities themselves.
Yeah, they've been a little bit challenged of late, at least in the short to intermediate term. XLE at the height of the tension in the Middle East, XLE bounced right up to a key resistance area and got rebuffed, now selling off again. So I think it's got some challenges in the very near term. I would say from a constructive standpoint, if you zoom out a little bit, we saw XLE, in the post-COVID period. You saw an explosive rally up into 2022 when a lot of the other stocks were struggling. Pretty much gone sideways over the last 2 to 3 years, and coinciding with those highs that we saw back in 2014. So you could argue we've got a long-term kind of modified cup and handle situation going on. So we do maintain a small position in XLE. If it does get back above that 90 level decisively, that would open up upside back towards the highs around 100. But I do think eventually we get a breakout above that 100, and you're going to see a pretty explosive and durable next up leg to XLE.
Dan, are you seeing anything in natural gas for a market that is usually more volatile than oil? It's been pretty boring, quite frankly, for the last few months, trading in a fairly tight range. So anything happening on the natural gas front?
Not a lot. It's pretty much basically as you described. They call it the Widowmaker, obviously, because it's kind of tricky to trade. And I have found that to be the case in the past when we've tried to exploit some opportunities there. We did successfully trade it on the long side earlier this year, a small position, made a little bit, and then stopped ourselves out on the rest maybe a couple months ago and have had no interest in trading it. One, because it is the Widowmaker, and two, really, like you mentioned, it's basically gone sideways. I don't see a compelling reason to trade it either, long or short at this time. So we're out of that market at this time.
Well, Dana, we've talked about the Widowmaker trade. Let's talk about the Heartbreaker trade next. Silver. Silver had a pretty big rally over the last couple of weeks and then sold off a little bit. Now it's kind of channeling sideways, but it broke above key resistance at $35. A lot of people have been watching for that multi-year resistance to break. Now that it has, it's just kind of floundering around. How are you looking at silver?
Yeah, we're long. We've been long SLV, as you know, been making a nice methodical series of higher highs, higher lows. We trade SLV. Scrolling back to the highs from 2011, you have the 61 retracement right around that 34 level, right where we topped out a couple days ago. I think it's still constructive, still holding a position. We might consolidate here in the short term around that 34 level, but any pullback towards that breakout area around 31, 31 and a half, certainly we'd be adding to our position.
Do you have any targets for SLV? Where it could go on the high side here? What the upside is?
I would say we break that 34 level. We're looking at about $40 next, which again, people like to throw out the huge numbers just to get some clicks or some eyeballs, but that's, a pretty healthy 20% move. So I'm in it for that for sure.
Well, and again, if we shift over to the equities, SIL, the ETF, has done quite well, but SILJ, the juniors, dragging butt a little bit more, not quite as peppy as SIL when you look at it over the medium to longer term. How are you looking at those two ETFs of silver equities?
Yeah, we're long both of them. We've had a larger position in SIL. Certainly, that had broken out to multi-year highs. That has further upside. Trading around 47 right now. It's got upside immediately towards that 53 level, which was the high back in 2020. Like you said, the juniors have been lagging a little bit, have not been able to hit multi-year highs, kind of struggling at that 15 and a half-ish level. But we did just add to our position yesterday around close to 14, around 14.10 on the pullback when it closed that gap from earlier in this month. So we're long both of them. Obviously, SIL right now has a little bit less resistance on the charts, but at the same time, if the juniors do kind of make a comeback or play catch up, maybe there's a little bit more juice to that one. So we've got both positions on, a little bit more in the SIL though.
Clearly interest in SIL. Look at that volume that we've seen this month. Holy, this is by far and away the highest volume ever in that ETF. Let's move to copper because copper is also making a move back above $5. It's been there a couple times before, earlier this year, back in 2024, and even peaked its head briefly there in 2022. But look, this copper chart also showing an upward bias ever since that 2022 sell off. What are you seeing in copper?
Copper, been more range bound, I think, overall. You have seen higher lows, especially for the last several months, but we don't have a position on currently seeing it more range bound. It would have to do either pull back towards some compelling support level or break out to new highs for us to have any really compelling interest in it. We've seen, especially in this environment where we have no shortage of compelling relative strength targets to attract our money. I at this point, at least, we're not really forcing anything into copper right now.
Well, Dana, you probably know where I'm going to go here. What about the equities? And I want to look at COPX, which I think you do trade and follow, but also COPJ, the juniors, recently have been a little peppier than we've anticipated and peppier than they've been in the recent past. So how are you looking at COPJ in addition to COPX?
COPX is one that I track on a regular basis. I have a nice breakout today. Obviously, that opens up after consolidating most of the year, hitting a new year to date high. So that one certainly looks good, especially on any sort of a pullback towards the mid to upper 43s. I would say I'd be interested in getting back involved in that. COPJ, it looks a little bit more constructive to me. Looks more like we talked about a modified cup and handle earlier. That has the same potential going back, looking back a couple years or at least a year back to 2024. It's been kind of rallied back up to that area around that 25 level a couple weeks ago and has been consolidating nicely there. Looks like it's setting up or refueling for a potential breakout. And I think the longer it consolidates here prior to that, the more sustainable that breakout would be. So that one is certainly on our radar.
Back to the precious metals. One other precious metal that's caught a lot of attention recently is platinum. It's literally gone vertical in the last maybe 30 days, not even 30 days, trading at some multi-year highs here. What's going on in the platinum market?
Well, it's going higher. So that's all I care about really as a money manager. And we continue to see more and more demand come into it. So you had that explosive move. And really, I would have liked to have seen it consolidate a little bit more around those highs from, I guess it was about 4 years ago. But instead, it just got basically shot right through. So in our view, that's harder to chase. That those types of moves where they just blast to multi-year highs without even pausing at the former highs, those moves tend to be typically less sustainable. So I'm not chasing that. If it does come back to test that breakout level or those former highs, then maybe I'd be interested. But those types of moves kind of scare me in terms of, like I said, chasing it just because they don't tend to be sustainable. They could be explosive. They could, in the short term, they could go much higher temporarily, but again, they don't tend to be sustainable moves.
Well, Dana, just in a broad sense, I know that you don't like to do the intermarket analysis, but the US dollar being so weak, especially most of this year, I mean, it came into the year pretty strong, but it's weakened throughout the year. It usually is a tailwind for the commodity sector, sometimes even the general markets. But I know that you like to look at each asset class on its own. When you just isolate the US dollar and look at it technically, what are you seeing on the charts?
Yeah, well, in that case, there's undoubtedly that intermarket relationship with some of the obviously the commodities, other currencies by definition, and then it also comes into play with a lot of the international equity ETFs that are priced here in dollars but track international indices or international stocks. So certainly does have a big impact on that. What we're seeing is I saw major support around that 98, 99 level on the dollar index, breaking down below that now. So that opens up further downside, which should have more continued impact on some of the commodities. favorably. And also at the same time, a lot of the, like I mentioned, a lot of the international equity ETFs here in the US priced in dollars, having a very positive impact on those.
Well, that's the thing. International markets have also done well, as the U.S. markets have done very well as well. But Dana, just looking back on even a longer term chart in the dollar, we haven't seen this sort of a sell off this quickly very often. So, how concerned do investors need to be that, yes, the dollar is sold off very hard? Does that mean that it just keeps on going, or is it one of those things that does get overdone, being such a large market?
I mean, obviously, currencies are going to trade in a range, and like much like commodities. So we've talked about this before, whereas equities have theoretically unlimited upside. These types of like commodities and currencies are going to be more range bound or limited in the moves that they make. So I would say, I would say the breakdown that we're seeing right now is significant, could certainly open up further downside to the mid, or I would say the low 90s potentially, which would continue to have a kind of a tailwind effect to a lot of the commodities, obviously other currencies, and like I mentioned, those some of the international equity funds that are priced in dollars. So that will continue to have a positive effect on that. But like you said, it's eventually it's going to be constrained at some point. It's not going to zero. We know that. So a lot of one good way to monitor that is just kind of positioning, hedge fund positioning from the CFTC, commodity positioning, and when traders get a little bit off sides, a little imbalanced, that's when you can expect to maybe get a reversal, at least to stop pressing the pedal down at that point.
Well, Dana, you mentioned the effect the dollar can have on some of the international markets, and we've talked a lot about international markets doing well, especially recently. Which ones really have your attention as far as the most relative strength?
Well, you're seeing a nice rotation, a broad, swath of international markets that have performed well, starting with Europe, which is, I would say, in the intermediate term, still the leader, whether it's a broad European average or individual market. Italy and Germany, some of the smaller ones, Ireland, really doing well. Some of the pigs, even. You're also seeing now emerging markets that have lagged, at least emerging market funds here in the US, which have been kind of laggards, really playing catch up now, really look attractive from kind of a catch up basis if we continue to see more rotation into them, both as just looking today, both the emerging markets equities as well as emerging market bond charts are really compelling right now. So you've got a nice rotation there. And then if you don't want to pick just a single country market because you're a little bit skittish about maybe geopolitical events, risks, whatever, just a lot of the broad international indices really looking good, from the EFA to the global Dow to the ACW, really across the board looking as attractive as they've looked in really a long time. So like I said, a broad array of relative strength, which we've talked about in the past. The stronger the breadth of relative strength names, the stronger the market is. So it still remains that way here.
Yeah, it really does. Well, let's get your outlook on U.S. markets, because as we're recording this, it's very late in the day on Thursday. The S&P is so close to all-time highs. Even the Nasdaq back up almost at all-time highs. The Dow lagging a little bit, but hey, overall, this seems like just a good market overall. A lot of opportunities to make money. What do you think the potential is for the broad averages, the S&P, even the Nasdaq, to reach these all-time highs and just keep on going?
Yeah, well, as measured by our models, our models look at what's happening right now. And right now they're still constructive, meaning the majority of the broad market continues to move higher. And that's all we care about right now. And then when we're deciding where to invest, then we go to the relative strength. But just looking from a broad market perspective, our models are still constructive, which means in the intermediate term, we still see further upside. We're seeing, the NASDAQ and some pockets in technology breaking out to new highs, some of the large cap growth back to a leadership position, hitting new all-time highs. You have seen one area of concern is that some of the smaller mid cap averages, some of the equal weight averages have not been able to kind of hit new highs or higher highs, stuck at resistance that they've been in for several weeks or a month or more, which is a kind of a strange dichotomy, considering the strength in some of the breadth measures, some of the internal measures that feed into our model. So we're not that concerned about it. It does pose a possibility where those broader, smaller mid-cap averages do break out to new highs and then start to play catch up, would be another source of potential demand or potential, money flows into those smaller averages, which could be, another source of fuel to continue this rally, which, I think looking back from washed out conditions in April to where we are now, we've had a great rally. I think most measures that we look at are about neutral. So we could have certainly much further to go in this rally, and that's what we would expect to see.
Yeah, it would be nice to see the small caps and the mid caps catch up to the large caps just as a catch up trade and put a little more fuel in the rally. But it is a strange environment where the large caps are outpacing them by so much. What about within the realm of different sectors inside U.S. equities? Is there one or two particular sectors within it that you really think, hey, these are the ones that you want to be piled into?
Yeah, there have been a number of sectors kind of taking turns leading the way. Obviously, some pockets in technology have returned to a good relative strength position. We talked about a couple funds last time. Cybersecurity looks great. Technology, the dividend space within technology looks great, hitting new highs. I would say industrials may be poised for the next breakout and the next new leg higher, maybe poised to lead the way. You have pockets in financials, look at broker dealers this week with really strong breakout after consolidating at those former highs. So, and then you even some of the defensive areas like utilities that have kind of consolidated, kind of moved sideways while growth stocks have kind of played catch up and taken over leadership. They haven't really sold off. They've been pretty firm. So maybe something like utilities for a portion of your money if you're scared about chasing some of these breakouts. So really there's no shortage of opportunities that we're seeing out there. That's probably the healthiest, most constructive thing about the market right now.
Dana, when you take a step back, just to your comment there about healthy, constructive markets, yeah, the small caps aren't running, but doesn't that sometimes mean that it's a more stable bull market when you do have the bigger stocks moving higher and some of the small caps, they're small caps for a reason because they're not necessarily fundamentally the best companies. So maybe that more divergence that you get with the big names running and the small caps lagging just shows that investors are focused more on quality rather than trying to chase outsized returns.
Well, maybe from an economic standpoint, you might be right. I would say from a market standpoint, what we've seen in the past is when the broader averages, when the broader markets lead the way, that is a stronger, more healthy, more constructive sign. So if you saw small caps and the value line averages, like the arithmetic that tracks the average stock, the geometric tracks the median stock, when you see those averages leading the way, that's, I think, from just an investment standpoint, from a market price standpoint, that's when you see the most constructive, most healthiest markets, when those broad averages are leading the way, as opposed to maybe just the large caps. But again, I don't, it, to us, it's not a huge red flag that the small caps aren't leading, because we are seeing strong enough breadth, strong enough internal statistics to keep our models positive. And you look at something like, the advanced decline lines, and NYSE advanced decline line is at an all-time high. So you do have that broad support below the surface, even if you're not seeing it maybe in the small mid cap averages. You do have enough broad support in the overall market to continue to move this thing higher. But I would say I would kind of go against the grain there and say it would be extremely constructive if we did see the smaller and mid caps and the equal weight averages break to new highs and start leading the way. Then you would have basically, then you'd be hitting on all cylinders. And obviously, that wouldn't last forever, but in the intermediate term over the next, several months, which is where we operate, that would be an extremely constructive sign.
Well, Dana, I think the only market we haven't really touched on yet is the cryptoverse. So, any thoughts on Bitcoin or Ethereum?
Yeah, Bitcoin looks good. We do have a position in Bitcoin. We think it's consolidated constructively here, held up nicely. I envision new highs in that space. We've avoided kind of my philosophy over the last maybe year or so since we saw kind of Bitcoin hit new highs. I guess a year ago, and we saw the other cryptos kind of fail to hit new highs. You saw Ethereum really hit lower highs at that point. My thought is I only have, and I'm not an expert, in the nitty gritty of the crypto space, but from an investment standpoint, I don't see any reason to venture out of Bitcoin if I'm going to trade crypto. And from that standpoint, Bitcoin looks good for new highs. I did make a trade in Ethereum. I thought maybe, and this went against my philosophy. I thought maybe it was going to play a little bit of catch up earlier this month. That kind of didn't pan out. Now you have kind of a dead cat bounce over the last couple of days right into kind of the breakout point, some resistance here in Ethereum. So actually just this morning I blew out that small Ethereum position, but Bitcoin do have a position on, and I do think it looks constructive for, another up leg here eventually.
All right, Dana. Thank you, as always, for sharing your thoughts. Sounds like still a lot of opportunities out there. And for all the bears that are trying to fight these markets, at least from what Dana's telling us, you're going to be fighting a pretty tough fight here because markets are continuing to move higher, even in the face of a lot of geopolitical tensions. But hey, a lot of the recent economic data has been okay. And quite frankly, markets just continue to trend higher, along with a number of other kind of subsets, including the commodities. So, Dan, I really appreciate your thoughts, and everyone, stick around. We are going to be right back, diving down a little bit more into some of the metals, equities, more so than anything.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. I hope everybody enjoyed those first two segments with Dana Lyons. Now, as promised, we're going to shift our focus even more so to the precious metals and even talk about some of the underlying precious metal stocks as we're chatting with Brien Lundin. Brien is the editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference happening this year, November 2nd through the 5th. I will post a link in the show notes for the weekend show so all of you can learn more about that conference. Hopefully join us down in New Orleans at the beginning of November. Brien, talking about the gold market, we're recording this on Friday, and gold, silver, precious metals broadly are fading to end the week. Gold right now just below 3,300. Again, still a strong level, and gold has been consolidating in a tighter and tighter range. I think a lot of people looking to early July or even mid-July as a decision point for gold. Is it going to break higher? Is it maybe going to give up some of these gains? But overall, $3,300 gold has been very strong. And this whole bull market in gold, or in the precious metals, let's say, has really been led by gold. Gold was leading to start off. Gold was breaking out ahead of other precious metals. Silver has started to play a little catch up. And the underlying equities, the majors, were leading the charge. We saw a little bit of trickle of money into the juniors, but that has also faded over the last about week and a half. So, Brien, when it comes to this precious metals bull market, as you and I were chatting off, Mike, this is the best market I've seen for precious metals in over 20 years, really dating back to kind of the tail end of that historic run that ended right around 2011. But Brien, what's your takeaway from the way this bull market is playing out for the precious metals?
Thanks, Corey. Yeah, and you are absolutely right to stand in astonishment at this gold bull market. It's been absolutely remarkable, and my argument has been that it's absolutely unprecedented. It's unique in the history of gold bull markets. Now, there's only been a few gold bull markets, since 1971, but still, this one is unique, and it is unique for the primary reason that it was started and has been driven largely by central bank buying. And this has resulted in a couple of things. One, because the buying has been strategic and not according to the shifting emotions of investors, the corrections in this market have been much shallower and shorter than traditional technical analysis would have predicted. The other thing that's really unique about this market is because central banks have driven it and central banks don't buy mining stocks and they don't buy silver, these two traditional levers to gold have been late to the party and sporadically involved when they have leveraged gold. That has changed, though, in a good bit. It's changed this year so far. In the first quarter, the only sector out of all the investment sectors out there, stocks, bonds, all the subsectors, the only asset class or sector to beat gold's performance was mining stocks. Gold went up about 16% in the first quarter. Mining stocks about doubled that return, and they've continued to do that. Now, what's interesting, and I think what you've gotten at, is the fact over the past month or 6 weeks or so, we started to see the junior market wake up. Not only was it the big majors, but that filtering down the food chain that we had hoped for and that we've seen in every previous bull market environment was starting to happen. If you plot the Toronto Venture Exchange Index, which is not the best proxy, not the perfect proxy for the junior mining sector, but a pretty good one. If you plot the venture index against the big GDX gold miners index, you can see that the venture index, and by proxy the junior miners, started to outperform the big miners sometime around mid-April to the end of April. And they traded sideways for a while, but recently they've actually begun to outperform the GDX or the big miners once again. That is precisely the kind of environment we want to see. And, in addition to this quantitative evidence that we're seeing, qualitatively, we were talking about how many financings we're seeing that are coming out as bought deals at good prices with very little, if any, warrant coverage, and just a financing environment that has really perked up.
Well, Brien, I think it's an interesting environment for sure when you consider that when you go all the way back to 2018, towards the end of that year in October, November, that's really when some of the best in breed gold producers started moving higher. If you go back that far, that's when K92 and IM Gold and West Dome and Agnico Eagle and Alamos Gold, that's when they actually started running, was back in 2018. But it took until last year in 2024 until the rest of the gold producers started waking up because their margins started expanding so much. So even though there was a big run in place that had been happening for years in tandem with gold's rise, it took till last year till we got over 2,100, and really it took till we got up to 2,500, 26, 2,700 before you saw the gold producers really start getting more momentum. Now this year, as you highlighted in Q1, we saw the rest of the sector finally wake up because gold was over 3,000. Are you surprised that it took as long as it did and it took over $3,000 gold to really get the animal spirits going? And now that silver is up over 35 and we've got that part of the spectrum going, are you surprised it took this long?
Not really, but I'm not surprised because of what we just discussed as to why this bull market began and how it began and how it was fueled, by central banks. I would not have predicted that involvement by central banks to that degree, at least. But, events overwhelm everything else. If you look at when the central bank buying began, it was in the spring of 2022 after Russia invaded Ukraine and after the allies came up with all those sanctions, and central bankers began to realize that they too could at some point in the future be victimized by such a US-led coalition, or by anyone in the US or any administration in the US that so wished. So they began just hedging their bets with gold. China was a big part of that, and we have a good feeling what their motivations are and have been consistently. So yeah, it kind of started in 2022. And what's interesting to me is that prior to Russia's invasion of Ukraine, we were getting a nice little run in gold. But that geopolitical event actually forestalled that kind of nascent gold bull market, because gold ran up on the eve of the invasion, and after a week or so, it ran right back down. And people conflated the rise in gold with the geopolitical issues, and we began a fairly steady downtrend from there. So, it is interesting that it has taken this long, but I understand why it happened, even though I didn't predict the events that led to it happening.
Brian, the one thing that really stands out to me is how much debt is on everyone's radar right now. I know that in the gold community, people have been talking about debt really ever since I came into the community, a little over 2 decades ago. But now it seems to matter a lot more. And it seems to be even more so talked about on both aisles in politics. In the US, Trump came in saying he was going to get debt under control with the big, beautiful bill. That seems to be the opposite of what's happening, where debt is just continuing to expand. And this is all happening when the economy is doing pretty well, too, when you would think that they might be trying to get their house in order. But now, as I said, both sides of the aisle are talking about it. Clearly much more focus on this, even though I'm sure when we get to the debt ceiling, it'll get raised and raised again. But how big of a change have you noticed this being, where mainstream media right now, who does like to beat up on Trump, so he's giving them a reason to beat up on him because of what he ran under, being getting the debt under control, not getting it under control, but now a lot more people are talking about it, and that is a key driver when you price gold in US dollars.
Yeah, the gold bug, the sound money community, and my many, many years of being involved with it, one thing I've noticed is that they're often so far ahead of the crowd that they're essentially wrong. Our friend Rick Rule says that in investing, the synonym for early is wrong. And yes, we've been talking about this for a long time, about how the debt is getting out of control. I've been hearing really smart people talk about it for decades and nothing happened. But about 5 or 6 years ago, I looked at the numbers and realized that it really was getting out of control and becoming an issue, and started talking about it an awful lot in Gold Newsletter. Now my voices and our voices have been joined by a chorus of really well-respected people on Wall Street. You've got Ray Dalio, you've got Gunlock, you've got Tudor Jones, you've got so many people talking about it now. And yet the only way this subject gets talked about in the major financial media is when these people are being interviewed. And you can see their interviewers, their eyes just glaze over because they can't conceive of anything happening. But the bottom line is these experts, these well-renowned figures, it's not just that they're getting to be old curmudgeons like some of us in the gold bug community. The numbers really are that outrageous. After 45 years of ever easier money and ever easier debts, the debt load today is so great that it can't be handled. It can't be handled without the entire budget and financial house of cards collapsing at interest rates that are anywhere near normal. In fact, the dollars that make up that debt have to depreciate at a faster rate than the rate of interest being paid on the debt. That means that interest rates have to be below the rate of inflation going forward, or everything falls apart. In short, we need negative real rates going forward, essentially forever. And that's what I believe is one of the primary issues, if not the primary issue, that's driving gold over the long term. I think in addition to all these titans of Wall Street we're talking about that are recognizing this, I think governments are recognizing this. Yes, the invasion of Ukraine and the sanctions environment has them desirable of some independence from the dollar hegemony. But also, they are realizing that there's a world of hurt coming up. There's some sort of a reset of all that debt, not just in the US, but throughout all developing economies, that has to happen. And in that environment, he who owns the gold has the power. So I think that is, fundamentally at bottom, one of the primary driving factors behind this central bank buying of gold.
Yeah, Brian, you said it well, and I think it's great that you also pointed out that it's not just the U.S., that all nations are doing the same thing, and that they've inflated their way out of their problems and papered over their problems for so long that really most nations have an untenable amount of debt. We've been saying for 2 decades that the math is the math, and it was already unpayable. Now it's really unpayable, so the only way to deal with it is to deal with some kind of financial reset. But that's just the driver in gold. I want to shift it over to look what's happening in silver, which again, central banks aren't buying silver. Look what's happening in copper, back over $5. Look what's happening in platinum. Central banks aren't buying platinum, but it's at 13-year highs right now. So you're seeing a reflation trade in a lot of these commodities and the precious metals and base metals. You're seeing critical minerals on the map. There seems to be an environment where through executive orders or through national focus in Europe, in China, in the US, really globally, that countries realize they need to start sourcing more raw materials. So maybe speak to what's happening besides just the gold bug narrative. There's a commodity reflation trade going on across the board here.
Yeah, there is. There is coincidentally, and to our great delight, there are actually two mega trends happening in mining and metals. One is in the monetary metals, gold and silver, for the reasons we just talked about. The other is base metals, and I throw platinum and palladium, the PGMs in general, into the base metal category because I don't really believe they carry much of a monetary cachet any longer. But that's a totally different story. Whatever level of global economic growth we have is increasing what has already been a very steep demand curve for base metals. And copper is a primary beneficiary of that because you can't really innovate around copper in electrical usages. So the EV story, the rebuilding of the electrical grid, the emergence of emerging economies that want all of the conveniences and that the developed world has, will put just the steepest demand curve we may have ever seen for any commodity on base metals in general, but copper in particular. And at the same time, we have had decades of underinvestment in the sector. In a sector where it takes 20 years for a discovery to become a mine, for a copper mine, there's not really a very effective way for the market response to come in. And that puts even greater pressure on prices. And we're just starting to see that in copper. Platinum is a supply demand story as well, with really falling stocks on the major exchanges and a supply demand pinch that's going to be quite dramatic and is developing to be quite dramatic. So we're very fortunate as investors in this sector that we've got both of these stories going for us.
So Brian, let's get into a little bit more of the equities, especially on the gold front. I'm curious your thoughts on this, where back at the peak of the last market, 2011, majors were out there buying, it seemed like almost everything. They were going down the food chain. They were buying lower margin, higher cost projects. Now they're not doing that. But what we're seeing in the junior and mid-tier space is that these guys are bringing these projects online. I'm seeing some all-in sustaining costs in the $2,500, $2,600, $2,700 region. So they are still making money at these levels, but it's not the majors buying them out. It's these other companies bringing these mines online or even acquiring some of these mines that haven't made money in years, maybe even decades. Now they are making money. But again, they're high cost assets. They're not tier one assets. How are you seeing this environment where the majors are staying disciplined? They're focusing, if not just on tier one assets, on other metals outside of gold, but now it's the mid tiers and some of the juniors that are running these high cost mines. They're at least making money right now, but they're not giving themselves a whole lot of wiggle room if we do get any sort of a significant correction.
Yeah, some of those costs are actually the costs of capital, which I think are going to start to come down as more generalists come into the sector. The big miners have been sitting on their hands and trying to show discipline so that they can be called, good stewards of shareholder capital and all this other stuff at the various industry cocktail parties and on Wall Street. Eventually, though, one thing we know is that they're going to start spending money like drunken sailors. On the junior end of the spectrum, they're just getting sick and tired of waiting around for the majors to come in and buy them at some ridiculous premium. Only the very best, the finest, the world-class projects are getting bought out at significant premiums. So if you're a junior explorer developer and you've got a great project, you have to keep working, you have to keep financing, you have to keep justifying your job. So that means if the majors aren't going to buy you out, you have to progress along that path toward production and act like you're going to bring it into production. In a lot of cases, if not the majority of cases, these companies actually do have that as their fallback plan. So you might as well do it correctly and to your best of your ability and hire the expertise that you need. In some cases, we've seen that result in the fact that these projects actually go into production because they just keep de-risking, and there you go. So yeah, it is interesting. I think the majors are going to come back into the sector, but because we've seen these mergers of the majors, there's not as many big players out there. And what we're actually seeing are these mid-tiers evolving and merging and advancing along that path to where they will soon be considered majors themselves. And they are, as you go down the food chain, you get greater and greater levels of aggression in the market where they are more incentivized to go out and do things and aren't as content to just sit on their hands. So yeah, it's interesting. It's evolving in a slightly different way than we've seen in past bull markets. But I think human nature is what it is and always has been. And at some point, these majors will start, the ones that are left at least, will start getting into bidding wars for the best assets.
Well, Brien, just to that point about the M&A cycle and what we've seen in prior cycles where they end up overpaying at the top, we haven't really seen that so far this time. We did see a lot of M&A in 2023 and 2024. So far this year, we've seen a few deals, but you would think at these gold prices and the value of the ounces in the ground that developers have delineated over the last decade or so, that you'd be seeing a dozen deals a month, and we're not. So you're a betting man, Brien. Do you bet that the developers get revalued higher before the mid-tiers move on them? Or is it a situation where we start seeing waves of M&A before those companies can get revalued? Because right now there's a nice arbitrage between producers and developers. What do you think happens first?
Yeah, I think the first actors, the first majors to go in and scoop up some of these developed or developers in their projects, they're going to get the best prices, and that's going to spark the re-rating that we'd like to see. And we may see some generalists come in and just say that the mining sector is stupid, look at the numbers on these projects, and provide the capital themselves. Starting to see some signs of that, but we'll see if that happens. So yeah, I think the first ones out there are going to get the best prices, and eventually the ones that can hold out the longest will get the best valuations for the shareholders of the developers.
So, Brien, where do you think the best opportunities are right now for investors that either want to rotate some money out of maybe their high-flying stocks or out of other sectors into the resource stocks, gold stocks, or for those people that just have cash on the sidelines saying they want a piece of this action? Where's the best opportunities?
Yeah, I continue to be very positive, as Shad mentioned, on those companies that have great projects. They have economics on them, perhaps. They have very large resources, and they're selling for still extraordinarily low valuations per ounce in the ground. That said, I'm a sucker for a good exploration play. We have a few of those in our gold newsletter portfolio that I'm excited about. I found myself, I don't know if it's a matter of strategy or just good fortune and coming across some good stories, but I found myself adding some copper exploration development plays to our gold newsletter portfolio over the last couple of months. Two in our July issue that's just come out. And I guess I have to say it's more of serendipity, finding these plays that have managed to get really good land positions in some of the best and most highly prospective and well-known copper belts in the world, and with great targets. So I'm excited about some of those, but I guess that's more of not just a strategy to play off the strong copper prices. It is just coming across some really good exploration companies at the right time.
Hey, even some of those are moving very nicely. And now, man, almost every exploration company is cashed up. I'm sure there's going to be a lot of news coming out in the back half of this year. Hopefully the market keeps rewarding that good news, because it has been now for a little while, but especially in May, boy, oh boy, did we see a whole lot of interest come into those juniors, up 50, 60, 70% in a matter of a couple weeks. Now they're fading a little bit, but overall, still a very, I think, healthy and strong environment for precious metals, but hey, something we will stay on top of. Everyone, thanks for tuning in, spending time with us on your weekend. Be sure to go back, check out our website, podcast, YouTube channel, and Substack page. Just search the KE Report, where you can listen to all our daily editorials, market updates, and company interviews. Brien, thanks again for joining us, and remember, click that link in the show notes to learn more about that New Orleans Investment Conference. I hope you all have a great rest of your week.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.